Ticker symbol DDOG is up around 7% in the past year, and today we'll be looking at an innovative player in a profitable industry which is an extremely high growth stock. It has solid fundamentals, improving efficiency ratios, and a 113 operation income year-over-year growth. So today we'll be looking at Datadog, a software company. In their annual report, they state that Datadog is the observability and security platform for cloud applications. It basically is a software as a service platform which automates infrastructure and user monitoring and security to provide real-time observability and security. So basically it allows clients to, for example, accelerate their digital transformation it allows them to reduce time to detect and solve problems with their softwares, and it actually allows them to enable operational efficiency. Now they have a strategy which can be divided into 4 different pillars, the first one being to expand their customer base by acquiring new customers. Now in their annual report, they state that they currently have a very low penetration in the market and they intend to increase this and attract new customers. Number 2 is to upsell their current customer base with new offerings. Now upselling basically means that if you have a customer you're currently selling one product to, you want to try to sell them a different load of products so that you can get a higher lifetime value for that client. Now number 3 is to continue investing to develop new products and to improve offerings. This I believe is extremely important as they are operating in an industry which is driven by high innovation. There are a lot of competitors which are developing very innovative softwares and they have to stay ahead of the game. And then number 4 is to expand their customer base internationally, as I think more than 90% of their customers are currently in the US. But now when we look at the financial analysis, we can see a company that is doing extremely well, even if it just started turning profitable in the past quarters. Now this is why they have a return on capital employed of 4%, which is a lot lower than the threshold of 15% we usually go for. Now, they have a very solid interest coverage ratio of 24 times, which means that they won't have to worry about debt anytime soon. And they have a cash conversion of 104%, which will maintain their investors happy as it means that they run very efficient operations. And at the end of the day, free cash flow is what us investors obtain at the end of an investment. Now, they have a very nice profit margin of 81%. However, they're not able to translate this into solid operating margin as it stands at 5%. Again, lower than our threshold of 15%, but again, this is caused by them being profitable for a very little time. Now, this is why I was telling you that this is a high growth company. As you can see, every single quarter, the revenue, gross profit, and net income has increased, and turns out that they became profitable in December 2023, and they've had 2 consecutive quarters of being profitable. Now, their operating income has soared by 140% in 1 quarter, and this is expected to continue as they improve their margins. This is why their efficiency ratios are now going through the roof in comparison to the previous quarters. However, when we look at return on invested capital, which is the one that we should look at more in this slide, it's right at a 5% as the return on capital employed was. However, it is expected that these ratios will keep improving, and when that return on capital employed or return on invested capital reaches 15%, we'll be very happy and this company's stock price will probably have rocketed high up. Now when it comes to their financial position, I love this company because they're not looking to over leverage their operations. Their total assets are more than double their total liabilities, which is keeping their current ratio in check, and their equity is way higher than their debt, which is again keeping their debt to equity in a very safe position. 2 things which you like to see from high growing firms. Now when conducting a fundamental analysis, this company gets a solid 7 out of 8 ticks, as first of all it has very low liability risk, second of all it has a very solid balance sheet, meaning that it is actually able to cover its short-term debts only with its current assets. Now this company is insanely consistent at generating cash flows, and these cash flows are actually growing organically. Now one thing that I love from this company is that although they've become profitable in the most recent quarters, they have been generating positive free cash flows for a very long time. These cash flows are extremely predictable, consistent, and the great thing is that they're growing organically. How? Well, this has to do a lot with the fact that they're actually growing their revenues organically as well, but due to the fact that they have a very efficient cost management scheme. Now, one thing that I like from this company is that their pricing power is great. Why? This is because they're providing a software that they develop themselves. This software provides a lot of value for their clients. And a lot of these companies do not change these type of softwares ever because of a lot of reasons. First of all, these changes usually involve high costs. When you have to move all your servers to a different cloud-based software, it is usually very expensive and companies don't want to do that unless they have a very good reason. And the second one is that these companies have extremely high retention rates, and in the case of Datadog, this is because they're providing an excellent service and all their customers are pretty satisfied with these offerings. And this, of course, goes hand in hand with the fact that they have a very wide moat or a very big competitive advantage. This comes in the form of happy clients and the fact that their solution is extremely unique, because no other company provides a solution which is so focused on observability that it basically has all the tools that you could need there and a lot more, which will help you integrate all your services and obtain real-time data. This is one of the key reasons of why they're actually growing their revenue so fast, which is their high retention rate. This, of course, acts as a competitive advantage, as even if another competitor enters the market, they will have to do it a lot better than Datadog if they want to get all those loyal customers that Datadog currently has. But this company does have one thing that I did not really like: the fact that they do not pay dividends, or the fact that they do not use all their free cash flow in order to conduct share buyback programs. Now, since this company became profitable in the past 2 quarters, there is no historic PE ratio before that, and it currently is trading at an extremely expensive price to earnings ratio because their earnings are still very low. However, when we look at their price to cash flow ratio, we can see that currently they are trading at a pretty expensive valuation, as it is higher than the previous quarters. Now, when we look at their free cash flow yield, they are currently yielding a 1.78%, which is smaller than the 3% long-term inflation rate, and this overall deems the company as at an overvalued valuation. Now, I see 2 main risks for this company, the first one being the worsening competitive landscape, and the reason for this is that there are so many competitors in this business. There are so many firms innovating every single day and coming up with unique, tailored, innovative platforms and offerings, which mean that if Datadog does not stay ahead of the game, they will lose customers in a very easy manner. And of course, I do believe that they have a competitive advantage, especially in the way of retention, which I've spoken about previously. However, this is easy to change when you're in an industry that has high innovation rates. Now, the second risk that I do see is their performance or not meeting performance objectives. And this is because, although their revenue has been increasing at a high rate, they're trading at such high PE rates that even one slip up in their growth rate, the market will be heavily impacted and prices of the shares will tumble by a lot. What I mean by this is that the market has very high expectations for this company, and that is not always good. Now, before we move on, please remember, I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a very strong competitive advantage. It provides one of the most consistent, predictable, and growing cash flows I have seen. However, it does not have high return on capital employed, meaning that it doesn't create value for the investor. So I do believe that this is a good company and it would very likely be a great investment. However, it's trading at such a high valuation that I will be staying in the sidelines for now. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trader Republic.